So welcome to part 3. This is where I just go through my expectations with a little bit of the macro outlook. Just remember, this is my personal view though. Okay, so yes, US politicians finally come together and agreed for a 45-day stopgap bill. That is going to keep the government open. Are we going to have the same sort of issue in 45 days, though, especially as it gets very near to Christmas? That's not going to be so good. There's been 15 shutdowns in 40 years. And for me personally, obviously I'm in the UK, so I'm not even American, but I trade a lot of American markets, as do many. And, I think it's really time that both sides of the house came together and agreed a formula, or at least a minimum annual increase, because that would ultimately prevent the potential for any further government shutdowns. And that's from either party, so that's got to be good for the country. For me personally, it's not only sort of pathetic, it almost sort of borders on irresponsible to place people's jobs and those payments in jeopardy. People getting their actual monthly payments, whether it's for a pay slip or whether it's where they're getting paid money by the government because they haven't got a job and such like, or for, just to help boost their earnings or just the household income. So I just think it's crazy. You're risking people's jobs. That's by the #1 economy. Still, at least now we're going to continue to receive the data. That's not going to be interrupted. And of course, we've got a lot of unemployment data coming out this week in the US. Car workers are still negotiating. And that could potentially be the biggest pay award in the industry for decades. And that will have a few knock-on effects, because then you could see other industries, or even within the auto industry, looking for higher wages, higher demand, again becomes a little bit inflationary. If these workers do achieve quite a high pay increase, then that's probably going to be reflected in higher sort of car prices as well. So, anyone shopping for a new car would again be paying more. So if we look at sort of the data from last week, WTI hit $95 before dropping back a little, but it's still over $90. Again, a little bit inflationary. Gold had a pretty volatile week and was absolutely smashed on Friday, hitting lows down sort of the low 1860s. And stocks were down on the week, although they closed off of those lows on Friday. However, that little rally that happened towards the end of the week could have been due to sort of any Q3 rebalancing and options expiries. So if you look at it, I mean, the S&P actually had the worst month of the year so far. So all eyes still remain on inflation. It is continuing to drop, but it is slow. And as I've said before, the closer it gets to that 2%, the harder it's going to be to achieve. Of course, if oil stays up above $90, we could see just a small little blip in that inflation data over the next month or two, which may not be enough to hike rates again, but it's not going to be a positive in the eyes of the central banks for sure. Now, interest rates may have finally peaked, although there's still a few central bankers commenting, saying there could be room for a bit more if inflation refuses to keep dropping. It's been my opinion all year that those getting our daily newsletter would be able to confirm this, that for me, central banks will remain committed to their fight against inflation, and they're just going to be willing to hike those rates to force it lower if they need to. You know, even eventually, if that was to sort of drive the economies into a recession. And for me, that's always been because it's easier for them to sort of push and to stimulate an economy, whereas for inflation, it's been much more difficult because a lot of it's been from the supply side, which has been difficult for them because they can't control that. And even when inflation is finally at 2%, central banks will want to see it there, I reckon, for at least 3 to 6 months, just to be sure that it stabilises around there. And 2% is their target rate, and definitely guarantees higher for longer. And we knew this because of that. They're going to want to see that steady. And of course, that doesn't necessarily guarantee that they're going to cut rates. It's just going to be a matter of spending some time there first. But, to me, this sort of leads to two questions. Did they go too far in hiking rates? Holding them higher for longer, again, is equivalent to probably another rate hike in my mind. And then, of course, lending's become tighter too. Households' cash sort of reserves are evaporating. And so that's naturally, along with higher prices, going to soften demand. But will it soften it too much? And of course, that lagging impact of previous rate hikes is still feeding into economies. Now, if they did go too far, then again, we could see some economies shrinking, probably Q1 of 2024. I still expect the US to manage that soft landing. I've got to be honest though, I'm just not as confident for Europe. And of course this leads to my second question, when are we likely to see any rate cuts? So for me, I believe that the ECB is more likely to be the first, followed by the Bank of England, and then finally by the Fed. Now, it's going to depend on inflation. Employment has continued to sort of hold up well considering the aggressive rate hikes. But unemployment levels are starting to creep higher though. I would expect that to continue into next year, except possibly sort of obviously over the festive season where, sort of part-time demand is going to be there. So will a drop in inflation and weaker data lead to rate cuts? The answer, I suppose, has got to be possibly, but eventually. And for me, any rate cuts that do come along are going to be small, they're going to be calculated, because they're going to want to prevent that sort of boosting of demand again and feeding into that sort of inflation. Possibly even when QE is needed again. There could be that sort of element where central banks, they might be prepared to cut rates, but are they going to be prepared to cut them aggressively and do purchase sort of the assets as aggressively as before? Or will they take more time to control the level of stimulus that they add and take it at a slower pace so they can see how it's impacting the economy, rather than that knee-jerk cut stimulus QE as they've done in the past? And again, after all, some of the blame for this inflation has to be put on the governments and the central banks due to the amount of stimulus that they did over COVID. Of course, the supply chain issues sort of stoked inflation to start with, and that was the initial trigger. And I think, when it comes to companies, profiteering, companies pushing their profit margins out as well, now we're in October, we're going to start to see sort of those Q3 performance. We'll see how big those profit margins really did get pushed to. Ukraine continues to counterattack Russian troops on several fronts. Now, the question probably there is going to be how much more progress can they make before winter sets in. Grain prices have been low in my mind, considering sort of Russia pulled out of the agreement that allowed Ukraine to safely export their grains, and then of course they started to bomb some of their ports. And what's even more sort of surprising where grain prices are is that US grain production is going to be down this year by the looks of it due to the hottest summer on record. Back to the EU, it's trying hard to lock in a trade deal with the US before next November's election, and of course that's just in case Trump does return as president. That's of course if he's able to. Chinese demand still low, and again that's going to be impacting EU exports, and this is quite noticeable with the UK economic growth now actually overtaken Germany and France. So they're both at the bottom of the G7. Isn't that a change of fortunes? The housing market in the UK remains under pressure though, and again, that's to be expected with higher rates, and it recently fell to a 6-month low. So back onto China. So it's China's Golden Week may add a welcome boost to the economy. Possibly just the airlines, but maybe a bit wider felt than that. So Xi Jinping has vowed to boost their sort of stuttering economy, but again he said that, but he hasn't actually provided any details of how he's going to do it. And the Chinese economy is still very fragile. Local government debt levels, weak real estate market, and there's potential for that even to worsen despite the efforts that the Chinese government's made to boost it. So if we look at treasury yields, they're high. Some are expecting the US 10-year to possibly even reach 5%. I'm just not so sure it's going to get there. But I do expect more investors to reduce their stock portfolios and move into bonds. You've got a guaranteed return, and that return at the moment is actually higher than what you would get from investing in stocks. So it seems the right strategy to do for me. Okay, so it's PMI week, and of course in the US we've got loads of employment data coming out as usual, first week of the month. And there's plenty of central bank speakers, including Powell on Monday. And then we do have a few more central bank rate decisions this week as well. So it should be a lively week. For me, it's going to be really interesting to see how gold and the dollar perform. So yeah, that's pretty much it for me on the macro outlook. I'm now going to do some analysis on a variety of asset classes. So I hope you stay for that, and I hope it helps you. Look forward to seeing you in part 4. So we offer newsletters, we offer workshops, 1-week courses, our comprehensive masterclass that's really going to help you. Apart from gaining all that fundamental knowledge, you get to spend 20 trading sessions with me, practical sessions. So that's I'm not saying I'm going to turn you into a massive trader in 20 sessions, but getting that sort of feedback from me, that insight from me, is valuable. Now other things that we offer are trader mentoring. We consult to companies on FX and commodity exposure. Of course, we provide a massive educational content to individuals, exchanges and brokers. If you feel underfunded, why not give the trading challenge a go, and see if you can get that funded account. Maybe you're underfunded, maybe you don't want to risk your capital, which is quite understandable. And of course, one of our courses now includes a free
attempt at the trading challenge. If you would like to find out more about anything, then contact us at info@symaxfintech.com or directly to me at chris.tubby@symax-int.com. Okay, so now we're going to go into the technical analysis section. So I hope you join us for part 4.